Next, we'll take a look at what is marginal costing, which is a topic in management accounting. Marginal cost is the cost of producing one extra unit of output and signifies the amount by which total cost is increased for an extra unit of production. So for one extra unit of production, how much is the cost for producing, that is marginal costing. Marginal costing studies the effect of volume and type of output on the profit of changes. Hence, it's a technique of costing which tends to aid management decision making and control. It is not, however, a method of cost ascertainment like job costing or contract costing. Used alongside such techniques as budgeting and standard costing, it is very helpful in determining profitability of cost centers, departments, processes, and products. It also analyzes the profitability of centers and interprets the cost on the basis of nature, behavior, and intensity of costs incurred in departments, including gains felt in the departments. In marginal costing, what is ascertained is the contribution of resources and profit based on the statement of marginal cost. In this statement, each product or department is taken and their contribution ascertained. These contributions are total to arrive at total contribution. Fixed cost is then deducted from total contribution to find out the profit. Usually there is no attempt made to apportion or keep for calculation purposes fixed cost to various products or departments. Next we'll see what is marginal costing and CVP analysis. CVP is cost volume profit analysis. So cost volume profit analysis helps the management in profit planning. Profits are normally affected by several internal and external factors and goes on affecting cost, sales, and revenues. The main objectives of cost volume profit analysis are profit forecasting, flexible budgets. It arrives at a proper pricing policy, performance evaluation for control purposes, and to expose overheads charged at different levels in production. So the following ways are used to represent volume or activity, namely production capacity, sales value, unit sold, direct labor, and machine hours. An example of CVP is a break-even chart or BEP, which is depicted as given below. So here what we see is there is a constant line, that is y is equal to constant. That means that line is the fixed cost. Then there is sales, which starts from 0 and it goes all the way. And then there is total cost. So as the sales goes up, the cost also goes up. And the total cost also is indicated by a line. Where the total cost intersects the sales, at that point is where it is break-even point. And the angle of incidence after that is profit, and on the left side of the margin of safety, that is loss. So BEP is the intersection point of total cost and sales. So this is one form of cost volume profit analysis. Next we'll take a look at what is marginal cost and decision making, basically make or buy decisions. Companies often determine whether it is better idea to make or buy materials, components, or even products that decide whether a company should indeed be a manufacturing company or a services company. Make or buy decisions are important and must be made whenever the expected cost savings provide on required capital investment a higher return and can be made effective by employing these funds in an alternate investment with the same risk. The point of difficulty in determining whether to make or buy are identifying and estimating relevant costs and in calculating costs under these considerations. For buy decisions, the firm has to make sure quality of the product is guaranteed, reliability of supplier in terms of financial and technical soundness is understood, and regularity is maintained by the suppliers. Also, each of the make or buy decisions are charted out in such a way that on a product basis, figures are drawn for sales price per unit, material, labor, overhead, marginal cost and distribution charges. After adding these for a product, a decision is made on which product to make and which products to buy by making sure which product mix as explained below or sales mix gives maximum profitability. So here different products have different product mix and that is relevant here. And depending upon which one product will be taken and whether to make that product or buy that product, that decision also will be taken based on that table. So that completes the marginal cost and decision making. So we have covered in management accounting, budgets. We have also covered standard costing and variance analysis, and we have also covered marginal costing. So thank you.